welcome to StockTwits TV. I'm Brian Shannon, but you knew that if you tuned in. Anyways, let's go ahead and take a look at these markets. We had another doji day on the S&P 500, so let's take a look at that. We've got, doji just means basically the market opened pretty much near where it closed, and as my friend Today Trader was pointing out, that's 3 out of the last 4 days and 4 out of the last 6 days that we've seen that, where pretty much the open and the close are equal to each other. We had a little bit lighter volume today, and when you look at this daily time frame, you can see we remain below a declining 10, 20, and 50-day moving average. So, you know, we're in a bearish market condition right now. The market can't get up back above this declining 10-day moving average right now, and prior levels of support are acting as resistance. So, you know, any long side trade that you're doing in here for the indices, you know, should be considered as day trades only. There are some stocks that are in uptrends that are going to, you know, just trade them on their own merits. But basically, we're in an environment that favors, you know, more short side trades today. But it's really at the same time pretty choppy. If you look at the 10-minute chart here, you can see we've been battling this declining 5-day moving average the last couple days. And today we had initially started lower and broke a little bit of support from yesterday afternoon. Quick sell-off there, which was nice if you caught it. I happened to catch it in the IYR using that triple one. It was the first time I traded. I think it was a DRV, was it maybe? Yeah, the DRV. Anyways, caught this nice move in here, and fortunately was quick enough to cover. But that's the thing, you've got to be, you know, whether you're bullish or bearish, you really have to be more of a day trade environment in here, as we've got just a lot of back and forth activity. Here's that, you know, on the 1 minute time frame, we'll look at that break of support, and it was really, we had a lower high at the that found resistance at the pivot. We had a declining VWAP. It broke down and then made this very short-term little consolidation there, and then was the flush, and you know, got down to S1. That held, and pretty much just chopped around the rest of the day. So for a lot of people, it was a, you know, frustrating day, a waste of time really for a lot of people, I think. You know, looking at the last 3 days, you could kind of make an argument for a head and shoulders pattern here with a, you know, kind of a funky looking neckline. You don't want to pay too much attention to these patterns, but recognize what they represent more than anything, and that is basically that we have a lower high here over the last, you know, from the last session, and we've got that declining 5-day moving average, which tells us that any trades that we take should be, you know, to the long side, in the index at least, should be a day trade only. So we back it up a little bit to a 30-minute time frame. You can see that we've also been battling this 108 level. We had first, you know, we had initial resistance at the little reactionary low from these January lows. That did turn into resistance last week. This week, obviously, we made it up to the next level, which is, you know, widely watched level, which was at 108 after yesterday's stupidity based around all that news. I mean, that was just a you know, foolish session, really. Anyways, we've got this market back to the 30-minute time frame. We've got this market still stuck below prior support. So support broken, tends to act as resistance. That's what we're seeing so far right now. And you've got to wonder if we're just headed. I mean, you look at this daily time frame; it's a mess. This prior, you know, here's this bigger level, obviously, as well. But it makes me think that we're probably going to head down, and ultimately in the next week or two, probably come down and test near this 200-day simple moving average. I realize we hit the exponential last week, but I think it's the simple 200-day moving average that we probably have a date with here over the next couple weeks. So anyways, you know, the market remains vulnerable. That's how you have to look at it. The Nasdaq, same thing. We've got a market that continues to be vulnerable to further downside, as we've got a declining 10, 20, and 50-day moving average in here. We'd seen you know, lighter, you know, the volume kind of trailing off here the last 3 days, as the market is just kind of really more neutral than anything. I mean, we're down 9 cents today, and it's pretty quiet in here. So I think that basically the lows of this week Let's just take a look at the SPY for a moment again. But I think the lows, clear all this off there. I think the lows, 106, then the lows in the Qs at this 4260-ish area, 4265. Breaking those levels, I think, is going to create another little mini panic that could see us head down towards the next potential levels of support for this market. And the bigger levels to watch right now really are probably still in both these markets near that 200-day moving average. So it's 2 points away basically. That moving average is obviously rising as it takes into data 199, 200 days ago and is replacing it with current data. It's still rising, but I think it's still realistic that by the time this this wave of uncertainty and this profit taking, this selling is done, that we could head down towards that 41 level. What we need to see it turn around is more of a more neutral type of environment here on a 30-minute time frame, which we're starting to get a little bit. I guess you could make that argument. I mean, if it could get back above 43.50, well then, what's your upside? Your upside's then probably up to this 44 level. So there's really not a lot of conviction. I mean, the best thing you can say, the best bullish argument out there seems to be right now that the markets are due for an oversold bounce, and that's really not much to hang a bullish opinion on. So, with these declining 5-day moving averages, they keep us suspicious of any rally attempts, and especially with the declining 50-day moving average. Basically, the way you want to look at it is, if you're a day trader, you trade in the direction, and these are generalities because moving averages aren't systems, but you generally want to trade in the direction of the daily VWAP. And then if if you're considering holding overnight, well then you want to look at what's the direction of the 5-day moving average. 5-day moving average is still heading lower, so you probably ought to be holding shorts overnight. But we're in this kind of neutral area as well, so you defer to the daily time frame and you say, wait a minute, we've got a declining 10, 20, and 50-day moving average. This market's still guilty till proven innocent, so I don't think you want to be holding longs overnight. And right now the shorts seem to be not working as well. We'd seen a little bit of a bounce in the financials today. They got a little bit of a short squeeze rally, I think, but still, they got above the 5-day moving average. But more importantly than that, the 5-day moving average is declining. So you look at that and you say, okay, during the course of the day, it's okay to trade these things long. It's okay to get involved in there and take that day trade up to daily R2. But be very suspicious, because these rallies tend to fail when we have a declining 5-day moving average. And you back it up again to the bigger time frame, the daily time frame. We've got this prior support in here at that $14 level. The market made it up to that 14 level, where we'd also seen the declining 10-day moving average. And today's, basically today's daily pivot, or R2 rather. So all those three things said, wait a minute, who's really going to buy and hold up here? I mean, can this market, can this ship right itself here under these conditions? Probably not likely, actually. So you got to remain defensive. The financials have been trying to hold and have so far successfully been holding above this 200-day moving average. But I mean, if they fail in this 1360 level, then you've got to look and wonder, well, what's the next level that this market is likely to drop down to? Well, I think you'd be looking pretty quickly at least 1310. And there wasn't a lot of trading in there, so price doesn't have much memory. There aren't a lot of participants. Let me move my face out of the way there so you can see that. Let me just go to the chart. So, there wasn't a lot of activity in this area. There's not a lot of price memory. There's not a lot of people, looking to basically, break even in there. So the bigger level would probably be closer to $12.70 or so. So these financials are pretty fragile looking. If you look at Goldman Sachs, Goldman Sachs is looking like big trouble here. We had seen all this activity up here, this support, that goes back to July of last year. So we had seen 6 months of support broken in here, and we could make an argument that we'll ignore that phone now. You could make an argument that this is even a shoulder, a head, and a shoulder. It's busted this neckline at 160. That return move is what should be shorted. Now it's just kind of consolidating here in this little pennant type formation the last week or so. But you look at that 30-minute time frame. Let's just get that to GS. You look at that 30-minute time frame. Let's go to a 65-minute time frame just to give it a little bit better perspective. We can see this downtrend line here, and maybe it gets going to the upside, but I mean this isn't a bullish looking chart, so it's not the type of stock you want to be buying. Someone asked me about Toyota. Should I buy Toyota? And I said, you got to be out of your mind to buy Toyota. Maybe for a trade, an oversold bounce, but these are broken stocks here, and they just don't heal quickly. In order for Goldman Sachs to be a purchase, in my mind, you're going to need to see it get back above 160 and hold above there. Then this will turn into, then we can look back in hindsight and say, there's this big, bearish trap. They're going to get, they're going to panic, and then you can see a short squeeze. But below this 160 level, you got to look at Goldman Sachs is in trouble. And you look at J.P. Morgan as well. J.P. Morgan, I mean, just a classic bearish looking chart. We've got, here, look at the last 3-4 days here as this market's rallying up on light volume. Just classic bearish flags in a downtrend. We get these little mini pukes lower. They bounce a little bit on lighter volume, showing that there's not a lot of conviction. It's not that value players, Warren Buffett's not going in there buying 20% of the company because he thinks it's such a good value here, and the market has it wrong. Instead, the message of the market is, these stocks are in trouble, and when your financial stocks are in trouble, it doesn't create a good environment for the S&P 500 in general. So we're still in trouble here, and you look at we already talked about the Nasdaq 100, but let's take a look now at the semiconductors. Semiconductors have been beaten down, better than 10% year to date. And now they're beginning to stabilize a little bit, but stability in a downtrend typically will get resolved in the direction of that downtrend. We're also, we're sitting at the 200-day moving average here as well. And these inflection points aren't areas to buy. They're a level to take a closer look at the market and say, what have we here? Let's take a look on a shorter term time frame. All right, so anyways. Let's take a look at the 65-minute chart. We've got a downtrend. Now we're starting to turn sideways a little bit, but typically, I mean, we've got these declining 10, 20, 50-day moving average. Any rally in here is likely to fail. Now, where is the important level in the semiconductors? Near term, I'd say the most important level is about $25.70. You can see that's where we had support in here. That support became resistance on the last day of January. It became resistance once again on February 2nd, and just recently we tried to get up towards there. We're creating higher lows. The 5-day moving average is flattened out a little bit. So maybe we get a little bit of a bounce in here. If it gets past that 25.70, maybe we get up towards 26 and a quarter. But looking at that daily time frame, we're still guilty till proven innocent, and if you're going to be trading these, you've got to be nimble. I've been talking a lot about the IYR. This group seems to me to be one of the ones that should still continue lower. We've been talking about the 4150 level. Today's low was, what was today's low? Today's low was 4171. So it came close to this prior low here, which was actually $41.58. And that's not the ultimate target, I don't think, on these. I mean, you look at it and you say, what's the next potential level of support? Well, the way the markets typically decline is they drop, they recover a little bit, they drop again in another wave of panic, they recover a little bit, suck in some new longs that will end up regretting their purchase, and they get down towards that, let's just call this the 4150 level, they get down towards that, maybe they bounce a little bit, and then they do what? Then they head down to the next potential level of support, where we had seen, prior activity, and where we'd seen something like a 200-day moving average. Those, so when we have this prior support and we see this 200-day moving average coming together in the same spot, well, that tells us that it's, that's the next potential level. Right now, what did we see? What did we see today? Well, we had seen a nice little sell-off early morning. As it broke these lows, which were actually yesterday afternoon's lows as well, right in here. I was pointing that out to subscribers midday. When we broke that, we fell real hard, and then we started to rally again, though. And you've got to be nimble, because there was an opportunity for great short profits first hour of the day today, but then it was a beautiful long side trade in here. But that beautiful long side trade brought us to where? Right up to that declining 5-day moving average. And right now it seems as though maybe the IYR is turning a little bit more neutral in the near term. We've still got this level here about 43.5 that you'd probably have to close above that to get me interested in these things for more than maybe a quick intraday day trade, but to the long side, that is. But maybe a little bit of stability here in these financials is what we should be looking at. Commercial real estate. But it's still in trouble. I had mentioned the real estate index first thing this morning. I had actually caught this trade but didn't tweet it, and then said looking for another trade right here. I figured as it was breaking these little lows, it was below the daily VWAP. I was getting out. I was getting involved in it. I covered it, half of it here. And as I had said, my stop was $90.95. Got out of the rest right up in there. I think I lost an average of 15 cents on that stop, that trade that I tweeted, and it turned out to be a good loss. Not a loss that I liked, but a loss that was worth taking, because had I held on, then it rallied up to 91.40, and I'm not willing to take that much risk in the trade. But if you back this up and take a look at 65-minute time frame here. We've got this prior level of support in here that this market is dealing with below a declining 10, 20, 5, 10, and 20-day moving average. Back it up to the daily time frame. It's just looking like that kind of rounded type of top that maybe it won't fall apart altogether, but getting down and testing this level, another time looks reasonable. And the next test of this 89.5 area might be the one that makes it drop down to the next level of prior importance, which is same thing in here. You look at these levels and you say, okay, if it breaks that and it heads down to this prior level, well, that gets us in and around that 200-day moving average. So a lot of these markets seem as though they've probably got a date with the 200-day moving average. I'm going to take a look right now at Twitter and see what stocks you guys are taking a look at, and I'll look at some of those.